Hello everyone, my name is Martin Colmorgan and I am the founder and chief investment officer of Serenity Alternative Investments. Today we're going to briefly review the philosophy and strategy of our flagship hedge fund product, Serenity Alternative Investments Fund 1. Fund 1 is our quantitative REIT hedge fund and is the only quant REIT hedge fund in the market. We offer our clients a diversified portfolio of institutional quality commercial real estate built using deep industry knowledge, modern quantitative tools, and a disciplined and repeatable process. So, why is it that you've never heard of a quantitative REIT hedge fund? Well, until now, the worlds of quantitative investing and REIT investing have essentially been mutually exclusive. Quantitative or multi-factor investors tend to ignore REITs because they break traditional quant models. And at the same time, REIT investors tend to focus on real estate fundamentals and employ more bottoms-up strategies. We believe that both practices have their strengths and that combining them intelligently creates a powerful vehicle for generating returns. What we end up with is high-quality real estate exposure via the REITs, a disciplined execution via a repeatable and mathematical process, and the ultimate output is superior risk-adjusted returns for our investors. Now, let's discuss this unique combination in a bit more detail as it makes up the core of our investment philosophy. We can begin with the publicly traded REIT market, which is the bedrock our strategy is built on. Publicly traded REITs own the highest quality real estate in the U.S. They have produced 10.5% annualized return since 1990, which is better than the stock market. And they offer the ability to invest in a huge variety of property types. Data centers, cell towers, warehouses, offices. The opportunity set within the publicly traded REIT market is exceptional. So bottom line, REITs allow you to build almost any type of commercial real estate portfolio that you can imagine. Now, the way that we build REIT portfolios is using our quantitative framework. This is the second pillar of our investment philosophy and what makes our firm unique within the REIT investing ecosystem. We backtest REIT data and create portfolios using a rules-based process. We combine the cold-blooded calculus of a computer with deep industry expertise to build a superior REIT portfolio. This framework helps us avoid behavioral biases and ensures that our process is really repeatable and scalable. At the end of the day, our strategy is pretty well summed up at the bottom left of this slide in saying REITs own the highest quality commercial real estate in the market, and we use a quantitative process to pick the best REITs. Now, this combination of quant and REIT investing did not arise out of thin air. The fund's strategy stems directly out of my professional experience. I am the slightly nerdy, yet still ruggedly handsome gentleman on the left. And I guess you could say I put the quant in quant REIT hedge fund. I majored in quantitative economics in college. I started my career at a firm called Quantitative Services Group. So yeah, a nerd alert. Quantitative Services Group, or QSG, that was a great place to start my career. It's where I learned the ins and outs of multi-factor investing, the code writing skills needed to build and maintain a robust backtesting platform, and a lot of that comes into play with how we formed the firm. After QSG, I migrated all the way across the investing spectrum to a group called REIF within Deutsche Asset Management, where I learned the REIT industry from the bottom up. We're talking property tours, building NAV models, meeting regularly with management teams, and in general using a value-based real estate framework to allocate large amounts of money into the REIT market. While at DWS, our AUM averaged about $7 billion, so we were significant players in the REIT industry. The result of my slightly unorthodox career path is a deep knowledge of both quantitative and fundamental investing styles, and that combination fueled the genesis of Serenity Alternatives. The handsome gentleman to the right of the slide is my business partner, David. He's a 26-year veteran of JLL, Jones Lang LaSalle, which is one of the world's largest real estate companies. David has a wealth of commercial real estate knowledge, an excellent network in the real estate industry. He's an investor in the fund, and he also happens to be my father. Now let's talk about performance. Our unique style within the REIT industry has allowed us to generate compelling risk-adjusted returns for our clients, and particularly over the past 15 months. Since January of 2019, Serenity Alternative Investments Fund 1 has returned 24% on an annualized basis with a standard deviation of 13.7, which puts our Sharpe ratio just over 1.8. Over the same time period, the REIT index has an annualized return of negative 7%, while the S&P 500 is analyzing at 4.8%. From a total return perspective, we've outperformed the REIT benchmark by 36% in just over a year's time, which really speaks to the power of our fully deployed investment process. Since inception, our outperformance relative to the REIT index is slightly narrower, but we've still delivered far superior nominal and risk-adjusted returns. Now let's spend a few minutes digging into the process itself and how we build our REIT portfolio. The process begins with our proprietary multi-factor model, which is designed to pick REITs that are inexpensive and growing the value of their underlying assets. We use the model to pick 20 to 25 REITs on the long side and 10 to 15 REITs on the short side. This model portfolio then passes through our risk management process, during which we assign portfolio weights, monitor sector concentrations, and make sure our portfolio risk exposures are within acceptable levels. We start with the multi-factor model, and we use the risk management process to build a portfolio. Now, to fully understand our process, it's important to know a few things about our multi-factor model, which, as we just discussed, is the strategy starting point. As a quick reminder, the model is designed to pick REITs that are relatively cheap and also growing the value of their underlying real estate. At a more technical level, the model is built using a selection of 19 factors from our library of 85 plus REIT factors, which just means that we've backtested a ton of REIT data points and are only using the best 19. Our model has excellent historical performance and is built on a strong theoretical foundation. Now, this is important because pairing theory with results is a key component to building a sound quantitative strategy. That leads us to the three main factor groups presented here of value, momentum, and quality. They may look familiar because they are similar to those used by some of the best quant investors in the general equity space, AQR, Research Affiliates, Alpha Architect, to name a few. These factor groups ensure that we are buying REITs that are cheap on a relative basis, are growing the value of their underlying portfolio, and tend to be higher quality from both a portfolio perspective and a leverage perspective. These are the types of REITs you want to buy regardless. Our process simply uses cold hard data and defined rules to add precision and discipline to which REITs fit these criteria. And the result is significant historical outperformance to the tune of more than 4% a year better than the REIT benchmark. So just to recap, we start with the proprietary REIT model built on historical data. The model gives us a list of REITs to go long and short, and then we have to decide which of these REITs make it into the final portfolio, which is the role of the process on the next slide. So this is the second phase of our strategy, which we refer to as the risk management process. Here we combine more quantitative tools and some human input, drawing on our deep knowledge of the REIT space to illuminate risks our quant model may be blind to. This is also where we enforce portfolio rules. Our exposure to individual REITs is limited to a maximum of 10% of the total portfolio. REIT property sector exposure is limited to 40% of the total portfolio and rarely reaches that level. And our library of risk factors allows us to monitor a wide range of specific risks and adjust our portfolio accordingly. In the current environment, our risk management process has proven invaluable, as through March of this year, our fund was able to avoid the majority of the REIT market's 25+% drawdown. So the result of this entire process is a portfolio of high-quality real estate companies optimized to generate returns without taking on significant levels of risk. Our clients get exposure to irreplaceable commercial real estate assets, such as Caesars Palace, owned by Vici, which is on the top of your screen here. Salesforce Tower, owned by Boston Properties to the left, and Equinix data centers, which are the hubs of global internet traffic. Again, high-quality real estate portfolio built using historical data and managed using a rules-based process. That is a quick description of what we're offering at Serenity Alternative Investments Fund 1. We're the only quant REIT hedge fund that exists. We have a process rooted in math, deep expertise in the REIT industry, and a track record that demonstrates the powerful return generation potential of our unique quant REIT strategy. So I hope you all enjoyed this brief strategy video. If you have any questions, don't hesitate to reach out using contact information on the screen. Thank you, and best of luck out there.